We believe the Fed got it right. They balanced the slowdown in the economy with the fact that utilization rates are very high, and they've indicated that after 3 years, they're coming towards an end. I think the market was just frustrated. They didn't address the balance sheet. For us, we look at something that might annoy the administration, that while the Fed raised rates, the PBOC actually eased. And for us, given the sell-off we've seen in emerging market debt, that's a sign to us to go back into those markets.
So there's no concern. I mean, I guess if the Fed is on the sidelines, then one of your biggest concerns about the emerging market trade has gone away.
Right. I do think that they've indicated they're coming towards an end here. And what's caused the emerging markets to crash effectively over the last 18 months has been concern about the withdrawal of liquidity by the Fed, and then, of course, the trade concerns.
Barry, after hearing what the Fed has said about rates and how they perceive their path, what does that do to educate you on how you perceive the equity markets and where the opportunities are?
So I think Powell made it pretty clear without pre-committing the Fed that they are pausing, that there will not be a hike for the first half of the year. Where I think he got it wrong is, can we talk about basements again for a minute?
Oh, the flooding and the liquidity, sure.
So here's the issue with that argument, and I actually sent an email to Kelly when I was watching Steve first say that the problem is, okay, there's a foot of water in your basement, but the regulators now require there to be at least a foot in the basement. And I think they fundamentally misunderstand the effect of liquidity coverage ratios and net stable funding ratios. And for example, Powell gave a speech recently and he talked about how the new money fund rules made the system safer. Well, those new money fund rules that don't allow a set NAV on prime money funds drove $1 trillion into government money funds. Well, what about all the companies that finance themselves in repo markets and commercial paper and the like? They no longer have that financing available. And when things get unstable as they are now, that liquidity tightens further. So they're fundamentally misunderstanding the liquidity argument. Furthermore, there was a $2.2 trillion swing in global central bank liquidity in 2018. 2.2 trillion, right? The ECB and BOJ bought $2 trillion worth of bonds the year before last. This year, they were flat and the Fed's balance sheet contracted. So that swing was 2.2 trillion. Next year, the number is more like 600 billion of drain, but the difference between minus 200 and minus 600 is much smaller than last year. So it should stabilize. But David Tepper is absolutely right. Issuance is up a lot. Liquidity is tight. And the Fed doesn't really understand how all of this regulatory stuff that forces banks to hold more cash than they previously did, when they reach that point where markets are balking, and that's what markets are balking about. So when he said, no, the balance sheet is fine, we can just put it on autopilot, that's a fundamental misunderstanding of how markets work.
The repo market, the commercial paper market, that really interests me in terms of, illiquidity is understated when you take a look at what's happening there. Which sectors are most, or which market caps are most exposed to that?
Well, I think you see it in all of the fixed income spread products, right? So someone was talking to me last night about BDCs and commercial and industrial lending. You certainly see it in CLO markets, high yield shut down. This is, by the way, the same thing that happened in 2016, because in 2015, the Fed stopped buying bonds. We lost $600 billion in petrodollar recycling, and the Chinese had outflows of $400 billion. So $2 trillion loss in demand. High yield went from 5% to 9+%.
That's not happening now, though.
Well, high yields moved quite a bit wider.
It should have moved a lot more if the concerns you're talking about are going to come into the cycle again. I mean,
I'm not talking about fundamental changes. I'm talking about just liquidity pushing spreads higher. And then the question is, are there knock-on effects? Now, I happen to think the core underlying economic momentum is really good and stable, but they've got to recognize that there's been this liquidity drain and that the Treasury is a big drag on this, and they've got to be cognizant.
Real quick, Bob, you like high yield here.
We do. If you look at where high yield's gone to, it's just backed up a little bit. Kevin's right. If you look at 2011, 2016, it went to 600 to 800 over. Corporate fundamentals look pretty good, at least from a creditor's perspective.